Statement of financial position for sole traders. Now let's understand this chapter. In India, as we prominently say balance sheet, in outside India, the term is statement of financial position. So there's not much of a difference between a balance sheet and a statement of financial position. So let's see. Statement of financial position is a list of the assets, liabilities, capital, and reserves of the business at a particular point in time. That is mostly the end of the year. Now, note the statement of financial position is not a part of the double entry model but is a list or account of these balances, and the income statement and the statement of financial position are collectively known as the financial statements of a business. This may also include the statement of cash flow, which we will see further in another chapter. Now, the statement of financial position is particularly divided into four main components, that is, non-current assets, non-current liability, and current liability. Now, let's understand these in detail. Non-current assets are the items which are purchased to use in the business. This is the keyword for a long period of time, that is, longer than 12 months trading period. Example, land and building, plant and machinery, motorway, equipment, etc. Okay. Next, current assets. These are the items that arise in the normal course of business, and they include inventory, trade receivables, and the cash and bank balances are usually added together and are called cash and cash equivalent. Now let's see non-current liability. This is the amount owed by a business. That is, the business owes this money to an outsider, which is supposed to be repayable for more than 12 months. This is important. For more than 12 months from the date of statement of financial position. Example, long-term loan. Now let's see current liability. These are the items which the business is due to pay. Same again, the business owes the money to an outsider, but the timeline is in less than 12 months from the date of the statement of financial position. Example, overdraft and trade payables. Now let's see the format of the statement of financial position, which is the most crucial part of this chapter. For the heading, you have to start by writing the trader's name or the company's name. Then you have to write the name of the account that you're preparing. That is the statement of financial position. Now this is important for year ended, whatever the year is. And then your particulars column and the to amount column. Now, as we saw earlier, the financial statement is divided into four parts, that is, non-current assets, current liabilities, non-current liabilities, and capital. This you will see and understand further. So, non-current assets, as we saw earlier, take the examples include land and buildings, motor van, office furniture, equipment, etc. So, you write the amounts in the inner column and then total it out. Then the current assets, that is inventory, trade receivables, cash and cash equivalent, etc. Whatever will be given in the question. Then you write the amounts in the inner column and then take the total out. Then you have to add the total of the non-current assets and the current assets to get the amount of total assets. Then we come to the liabilities part. Now see, there are two options. First, either you do this total liabilities part. If you do this, then you don't have to write this less and less. Or else, if you write this less and less, then you need not write this total liabilities. So current liabilities, examples trade payables and any other current liabilities that may be given in the question as an adjustment or in the trial balance. Then non-current liabilities, loan taken is an example and any other non-current liabilities they may have given. You write both of these amounts in the inner column separately in their headings respectively and then add out the total. Then capital. This will be properly given in the question. We will understand what is capital further in this video. But as of now, just see this. Capital at 1st Jan 2030, that is the opening. then add profit for the year, deduct drawings, and then capital as of December 2040, that is the closing capital. You do all the adjustments over here, you have to show that in the inner column and then get the final figure in the outer column. Then for total liabilities, you need to add the current liabilities, non-current liabilities, and capital. One very important thing is that always and always, there's no exception to this, the total assets should match the company's total liabilities. So in other accounts when we prepare, there's no this compulsion that they need to equal it out. So basically you're preparing that by your intuition, like okay, I've done this and this. Now it may be right, it may be not right. So here you have a very big advantage that if after solving the question completely, you realize that your total assets have matched with the total liabilities, then you are rest assured that your answer is right. Obviously, those amounts should be the right amounts to match, but still they are right. But however, in any case, which mostly happens, that your assets may not tally your liabilities, in that case, you need to go back to the question, read it again, go through. You might have missed some information or have made a mistake, okay, which you need to correct. So it's kind of an indicator whether you have solved the question correctly or not. That is a very big plus point. Now let's see some pointers to be noted. First, the non-current assets are grouped together and totaled, and the assets which are likely to have the longest years of life are placed first. So now if you see in this format only, the land and building compared to office furniture. Now a chair, for example, a chair and a table as office furniture compared to a land or like a whole building. The building will last longer, right? Obviously. So you usually write those assets which have the longest useful life first and then in the descending order. It is not compulsorily like important to have this like in that order only, but it is nice to have that. Like they may see or they may not see, but it is not a very big compulsion or they may cut your marks with this. Next point, it is important to maintain the order of the current assets. Now this is important. So the order is inventory, trade receivables, and cash equivalent. Now let's see what is this order. This order is sometimes referred to as the order of liquidity, as the current assets are most liquid assets of the business. Now, what is a liquid asset, you may ask? A liquid asset is one which is in the form of cash or nearly so. However, inventory is not a liquid asset because it takes time for it to be turned into cash. Anything that can be turned into cash easily is a liquid asset essentially. So cash is already in liquid form. So that is why cash is the most liquid asset of the business. But it is important that you note this order for current assets and write it in this format only. Next, the capital shown in the trial balance is the balance of the capital account that got forward from the previous year. So this balance they are talking about, capital at 1st Jan 2030, this is the opening balance of this year, that is the closing balance of the previous year. And it has its own working note. This is its working note. You will see this in further in the video. Now last point, working capital. This is also an important point. Please remember and note this. Working capital is also known as the net current assets of the business, which is calculated by current assets minus current liabilities. So working capital is equal to the total of current assets minus total of current liabilities. The difference is the working capital, or also known as the net current assets. There may be a follow-up question of like 2 marks which they may give by asking what is work, like calculate the working capital, or they may give in the trial balance itself the working capital is this. So you need to know and remember and work in the opposite direction, that current assets and current liabilities, the difference of that is given in the question, and accordingly they will give further information if it's that case of question. So just remember this. Now, if the current liabilities are greater than the current assets, then this figure will be known as net current liabilities. So, if current assets are more, then it is known as net current assets. If the liabilities are more, then net current liabilities. Now, the last part, let's understand the meaning of capital. Capital is the owner's interest in the business, that is, the initial amount of money invested in the business by the owner. Just imagine, like, if you're an entrepreneur or a trader and you have a startup, so there obviously will be an amount of money that you will be investing in it. So, that first investment by yourself, the owner, is called the capital. Now, it is important to calculate the amount of capital first by this working note given here, and then only transfer the closing amount to the statement of financial position. So now there's one thing, like as we saw previously, that you can do this working note in the financial statement itself, or you can do it separately and write the final amount over there. But it's very important that if there's any adjustment given, you have to compulsorily prepare this working note and then transfer only the closing amount to the statement of financial position. Now let's understand one concept, that is drawings. Now drawings is the money or the goods taken from the business by the owner. Now goods are also essentially money, like it has that value, right? The goods value is the money. For example, if I have a candle making business, for instance, then if I take some candles away, like the final candles, I take it for myself, then even that will be counted as my withdrawal from that company, that I've taken those candles, which essentially would have been sold and given me money, right? So the worth of that good is basically also counted as drawings. So the money, the cash amount, or the goods. Now let's see the working note. So you start by opening capital, that is closing capital of previous year. Then you add the profit for the year. Most importantly, the current profit. Always add the current profit for the year. Then you have to subtract the drawings made by the owner, that is in terms of the worth of goods or the amount of money, and then you get the closing capital. This has to be transferred to statement of financial position. Now there's two pointers. The accounting equation for statement of financial position is assets minus liability, like the total assets minus the total liabilities gives you capital amount or the amount of capital. And the second thing is that a statement of financial position shows the position of a business at a particular moment in time. So this is important, at a particular moment in time, and it is not a period statement like an income statement. That is, that period statement is essentially for a continuous period of time, and the date at which the statement of financial position is prepared must be included in the heading with the name of the firm or the trader.